Hello, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is my good friend, Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Welcome back, sir.
Hello, Commander. I love that chair. Thanks for
Yeah,
having me back.
yeah, it's always great having you on Wall Street Silver. I wanted to get you on to talk about all the excitement that's happening in the precious metals market, everything that's happening in the economy. Well, first we'll start off with gold. Where do you see gold going now till the end of 2024?
Higher. Question is how much, and probably accelerate if we start seeing a bit of a bear market kicking in the stock market, which we might get an indication from. We're going to publish this after the payroll number on Friday.
Hmm.
That might be a bit of a inflection point. To me, the macro for gold is I don't want to annoy our listeners and readers and viewers too much. It's just a matter of time. I think it gets to $3,000 an ounce,
Wow.
and now the key support is 2,000, which might have kind of bumped up to 2,200 for responsive buying and dips. But it's just a matter of time. And the key thing that's driving gold too is we still are having this, T-bills, 10, sorry, 2, just probably maybe peaked around 5%.
Right.
When that goes lower, I didn't say if. I think that might have been the peak for the year. And when or if the U.S. stock market starts having a bit of normal bull market back and full, I didn't say bear market yet. That should take gold off. It's what's significant about it is the World Gold Council just put out their latest quarter Q1 report. Those guys are good. I've been following them for a decade.
Right.
And Q1, there was 290 metric tons of net buying from central banks in their database since 2000. That's the most ever for Q1. So it's the premise I've been pointing out for years. When the deepest pockets on the planet, central banks, are accumulating gold, probably better go with that trade.
So do you think that a lot of time people in the precious metals market, we've been saying, oh, you need people from the AI market, you need people from the broader market to go into precious metals in order for it to make a move. But now you're seeing central banks buying up gold like they've never bought gold before at record pace. Do we
Yeah.
even need the broader market, like people from AI and people from all over the stock market to get into gold to make it skyrocket, or do you just need central banks to make it? Because the proof is in the pudding. Central banks buying gold at record pace, gold goes up. Do you even need the broad market?
It's all about rotation and
Oh,
cyclicality. And I think as far as needing it, well, it's proven it hasn't needed it because here's the numbers. We had significant outflows in gold ETFs. If you take from the peak, when gold ETFs peaked around 110 million ounces,
right.
there's been liquidation of about 30 million ounces. And that's like, what, 25, 30%.
Yeah.
At the same time, over that same period, there's been purchases by central banks of almost 100 million ounces based on the latest data. So it's offsetting. At some point, those ETF outflows are going to switch to inflows.
Right.
Just a question of time, and what it's going to take for that to happen. But I like to point out, just as we're speaking right now, gold on a this year alone is total return is around 12%. S&P 500 is around 6%. So it's doubling that AI-driven S&P 500. That's not a good sign. I mean, that's bad. And gold is since the end of 2021, which was a significant period because the Fed started tightening in 2022. Gold is outperforming the S&P 500 total return. And
Yeah.
all you hear about AI, I mean, AI and the rock beating stocks is not a good sign for the global macro economy. And that's kind of my tilt. I think that's what's happening now is that tilt we had towards severe recession last year didn't work. And the tilt we had toward this year towards no recession and no landing this year is tilting back. And key thing I want to point out is you have bond yields in China dropping to the lowest versus the US in our database, like 2.3% now.
Right.
Those long bond government bonds are indicating severe deflationary forces from a country we just can't believe their data anymore because it's really being led by one person who has a vested interest in making you believe a narrative.
Right. And what do you see happening, Mike, with like we talked lots about gold. What about the other commodities like copper, silver? Where do you see them playing out?
Let's start with copper and crude oil, kind of linked together. I think they both peaked for the year. I've been early on copper. I thought it would peak around $4 a pound. It looks like it's now peaked at $10,000 per metric ton in terms of LME copper. If it can
Right.
sustain above that level a month or two from now, I'd probably give up. But major signals a pretty good peak of, i.e., what I pointed out, what's happening in China, and pretty severe supply disruptions, some of it from Panama, some of it in China, typically are signs of peaks in copper. You want that
Right.
organic demand pull. And same thing with crude oil. Crude oil, I think it peaked at 87 this year, akin to 95 last year. Managed money net positions in crude oil, hedge funds, and almost all petroleum futures positions have peaked around the same level they did last year. It was around 15% of open interest. So you look at the macro and the micro, and they both show signs of peak. And the bottom line for us, Ivan, is when this hits the tape is if that S&P 500 can stay above that key inflection point around 5,000, I have to rope that in there because if it does continue to trickle and dip below 5,000, it can drop another 10% and still be an
Wow.
uptrend. All the dominoes tumble. And
Right.
commodities are showing severe deflationary forces. Natural gas is only major commodity I think has finally reached that low price cure. I think most are going to follow. Now, silver, I'm a bit stuck on. Silver, I'm still worried it's going to trade more like copper. You've been right; it's been doing well this year. But I think the problem with silver is it's more a beta to gold,
Right.
and gold is the only major commodity on the planet making all-time record highs. I think that's going to continue. Silver's just bumping up against resistance. So far, it's holding 30. Now it's backing down to 26. It's probably going to hold. But if copper does what I think it's going to do and the stock market goes down, gold's going to be the shining star.
And what do you see, like, there's been so much talk this week about the Federal Reserve and Powell and how, this whole year from the beginning of the year, people thought, we're going to get rate cuts. We're going to get rate cuts. That was the beginning of the year because they thought inflation is going down. Now there's talk of there could be a rate hike. Do you think that's possible?
It's possible it's not going to happen
No?
unless the stock market makes it happen.
Mm,
And let's put it this way: I don't think the Fed's going to ease until the stock market goes down and tells them to. I don't
right.
think it's coincidence that we've had a bounce, a pretty significant rally in the stock market from those October lows, which I feel is very suspicious, and sticky inflation and rate hikes expectations tilting away, being pushed away. It's the
Right.
high price cure. It's just stock market going up is it's the most significant period in history, I think, where the stock market is directly related to wealth and inflation, as is housing, as I look around the condos in Miami. And until those assets go down a little bit, we're going to have sticky inflation. So they have to go down, I think. Certainly the stock market leading for us to get the eases from the Fed. And this is the issue I think market missed is the Fed's not going to ease until risk assets go down and tell them to ease. And I think this U.S. stock market's the leading indicator. That's why I'm pointing out a lot that S&P 500, 5,000 inflection point. I see gaps below at S&P 5 E-minis, S&P 500 E-minis,
Yeah.
and just a normal correction. I will publish on Friday by the time this comes out that we just drop, 10% down to 4,500. Still just inching up towards significant upward sloping trend lines. It just got too high. So
Hmm.
to me, that's the thing about the Fed. The Fed to me is insignificant right now, and their next move will be ease. And I don't think it'll be until the stock market goes down and tells them to. And that to me might be the beginning of an elongated cat and mouse game that I think we're way overdue for a bear market in the stock market. It's just a normal cycle. I mean, it's the normal cycle is kicking in commodities is a bear market. Um, and that's where I think gold's sniffing it out. But what's going to change that? I think what I'm enjoying here is everybody keeps saying the data is strong, but you look at stocks like Starbucks
Oh
dropping, and I
yeah,
look, yeah,
collapsed.
yeah. I mean that's. And I look at my lead indicators. Diesel demand in this country has dropped to the same level as 10 years ago. It's like never happened
Really?
outside of a recession. Oh yeah,
Really?
diesel demand, paperboard, corrugated boxes demand is dropping. Unleaded gas demand is falling. I mean, we still have an inverted yield curve, and leading indicators are still negative. All that stuff that used to matter and then stopped mattering because the pendulum swung, I think it's going to start mattering again. And the number one thing catalyst is S&P 500 trading below, sustaining below 5,000. That's the first little inflection point. And that's what I do as a ex-trader, now strategist. You're always looking for the big picture macro and the inflection points. And here's a key reason why I think it's going to do that this time.
Yeah, why?
It's a well, we'll figure we get there anyhow. So I save you the question. Um, it's the number one major rules of markets is mean reversion can be the most powerful force in markets. And
Right.
in volatility, mean reversion always happens. It's just a question of time. So I look at the VIX volatility index. If you take the 20-week moving average or the 50-week moving average, I subtract out the T-bill rate because that's a major pressure
Right.
on the stock market is high T-bills and low volatility. And that level now has dropped below 9%. It's about the lowest level since 2007, which was one of my major signals that preceded the great financial crisis. Now, I didn't say I predicted it, but back then at that time, I was at a hedge fund and traded very well for it, being partly just expecting volatility to mean revert. So that was one of my key signals. And also the signal you get globally from CGBs, those are Chinese government bond yields dropping to the lowest versus JGB since about 2000 and, well, in our database since about 2006.
Well, that's that's pretty interesting that you had that in 2007 you were watching that and now similar things are happening like back in 2007. So now the next step, I know a lot of people have been talking about oil and how you're saying that it's possible that it could go lower, but what about with all the geopolitical tensions in the world and the ongoing wars? Do you think that even with all these tensions, oil is still going to go lower or no?
So full disclosure, I expect oil to get down to 40 or $50 a barrel. And people who've heard me for a long time say, yeah, McGlone, you said that 2 years ago. And yes, I did. I was wrong. I was early. If I was a trader, I would have been stopped out. But I still think it's going there, partly because it stayed elevated so long. So first of all, the example of what natural gas did.
Right.
Natural gas got way too expensive. It followed the high price cure, and it finally it's a major, only major commodities reached a low price cure. Cost of production in this country is 2. It got down to 1.6, which is the first trade in futures in 1990. We've seen some shutdown in supply and some increasing demand, and it's starting to
Right.
rotate up. Now it's about 2. I fully expect crude oil to do that. And what's keeping crude oil bid is geopolitical tensions. But the key question you have to ask yourself, and all traders are asking themselves, is has there been a cut in supply? No. In fact, what's happening by keeping crude oil elevated, it's adding fuel to the forces that pressured it in the first place. And
Right.
that is the excess of supply and demand from the US and Canada, about 6 million barrels a day, which is and the excess of which is adding excess to OPEC's spare capacity. And at the same time, demand is stagnant. I point out diesel demand in this country is plunging. No, I wouldn't say it's
Yeah.
plunging, but it's just never dropped this much in an expanding economy.
Right.
So it's a normal cycle too. I just like to point out how crude oil's made lower highs and lower lows since the peak in 2008 around $147 a barrel. And almost every single time it's been around 40 or lower. Now, the last one was negative 40. Okay, that was a bit extreme. But what happened? It pumped it back up to 130. Now, here we are as we speak at $79 a barrel. And I think it needs to get through that cycle that's normal in commodities. It's got to get through that low price cure. It's got to shut off what's really pressuring it in the first place. And that's that excess of supply and demand out of the US. And then there's that macro of I come from a farm background. We just have so many more alternatives. And then the EV proliferation is just, there's not the demand for it there used to be. And then there's a key force. The number one importing force in the world is China. And you look
Yeah.
at, you can't really believe their data so much, but you look at their bond yields and it tells me that that country has a big problem. And particularly after they pissed off their best customers by the unlimited friendship and then the war that ensued in Europe.
Right. Yeah, no, it's absolutely crazy. It's going to be real crazy 2024 from now to the end of the year. What's the timeline you give for the oil going down to 40? Do you think like from right now to the end of the year it'll hit 40 next 6 months, next 12 months?
Yeah, I actually said a few months ago I put Phil Kill on this. I think it's going to do it this year. I'm taking the risk of putting time with price. Geopolitics could keep it bid. Other things too, maybe some organic demand pull, which isn't
Right.
happening. But yeah, so I think that's. I'm basically putting Phil Kill on because I think people are sick of hearing it from me. But similar has happened. Similar, actually, more so, has happened in natural gas. If crude oil follows the path of natural gas, it's going to $40 a barrel. If it follows the path of corn, it probably get to 50 and change. The average cost of production this year is around 56 for
Right.
WTI crude oil. And every day that goes by, I've been looking at this Department of Energy data for decades. And one thing you don't mess with in markets is enduring trends. That's that enduring trend of of the excess of supply and demand out of the US and Canada. It's just had blips, and almost always it gives blips when prices go down, it'll go down, and then it goes back up again. It's
Right.
it's elastic. So to me, it's just a matter of time, but we'll see how that works out. I think the number one catalyst right now is, let's put it this way. I think crude oil has little chance of going up unless we have some form of supply disruptions. And if the stock market goes down, it needs the stock market to go up and supply disruptions. Now we've had inklings of those, but now at the point is where we had, it had a great year in Q1 in the S&P 500. The total returns peak was 11%. My that's a great year.
Hmm.
Analyze that, you're closer to 40%. But now it's giving that back. To me, that's the key factor in everything is I think beta is due for a bit of correction. Normal bull market correction means 10%, and it might be just getting started. So to me, those are all the bad things. Crude oil and copper are related. And I see the indications from plunging bond yields and just the little risks of mean reversion higher and very low stock market volatility and very high US interest rates.
Absolutely. Well, Mike, oh, where can people connect with you?
So I'm definitely in the Bloomberg terminal, but on LinkedIn, Mike McGlone, Senior Commodity Strategist, and on X at Mike McGlone 11. And for people, if they're interested, just reach out, send me your email. I'm happy to add you to my distribution list. And it's good talking to you. I love the commander chair.
Yeah, no, I'm super grateful for you coming down to Wall Street Silver, and I'll put your description and your connections all in the link below. So if everyone wants to go connect with Mike, you can in the links below. But Mike, again, such a huge pleasure for you coming down to Wall Street Silver. Hopefully, as the market develops, we'd absolutely love to have you back on.
Looking forward to it. We'll see what happens. And thank
Yeah,
you for
yeah,
having me.
we'll see what happens. Hopefully, hopefully all your predictions are right.